do you use technical analysis for?
I use technical analysis to manage my own personal pension, and fortunately in the last few years the techniques have worked extremely well. In fact, they've called just about every major stock market move that's occurred, and I'm not sure that many commentators or seminar presenters could claim the same for their techniques. In particular, Point and Figure, which I focus on in the courses, has identified most of the major moves. If I could give you a couple of examples, perhaps my best trade in 20 years was capturing a 5,600 point move on the Nikkei between 2005 and 2006. This move was from 10,700 up to 16,300 in a single trade, which is absolutely enormous, obviously. This move was called and traded using point and figure technique. The entry, the management and the exit were all done using point and figure. Also, I believe I was the first person in the UK to publicly call the bottom of the bear market in 2003, as it happened in March. Months later, some signals were given on more conventional techniques, but the market had already moved substantially higher. But the techniques that I teach in the courses were able to actually call the bottom of the bear market before anybody else was able to. And that's really what we're trying to do with the techniques. We're not looking for second or third rate techniques, we're looking for techniques that are ahead of conventional techniques. Plus also the Dow Jones, the move from 11,000 up to 14,000 was identified again using point and figure. So just about all the major moves that have occurred on the key markets have been called by the techniques that we use.
How can TA help investors?
Well, technical analysis for me is really about improving timing by having a method. And really what it's ultimately about is about probability. A good chart pattern or signal will give you a probability substantially better than 50%, so it takes a lot of the guesswork out of it. So you may end up with a pattern that has a track record of, say, 75%. Now, if an investor or trader is simply using those patterns which have good track records, then they are tipping the odds in their favour, rather than most people who are simply 50-50 on most trades because they don't have an edge, they don't have a method. So technical analysis is a method for improving market timing and for taking some of the guesswork out of it. Of course, it's not infallible, but a 75% record on a pattern or signal means that only 1 in 4 trades will go wrong. So that's a lot better than guessing.
How has TA helped your trading?
I've been using technical analysis for 20 years now. In fact, I started out using fundamentals for about 6 months and very quickly realised the limitations in terms of accuracy and efficiency. With charts you can cover hundreds and hundreds of stocks if you want. Compare that to the amount of time it would take to read through a company report. So I've been using technical analysis now for about 20 years, and I've looked at most of the available techniques in that time, and I think I have a pretty good idea as to which are the most reliable, and also importantly, which techniques are not very reliable. It's just as important to know what not to do as it is to know what to do. So avoiding techniques which have only average or poor track records is very important as well, and that is something we teach people as well as those techniques that they should be using.
So how can stock charts regularly predict what a stock is going to do?
That's a very good question, and one which I take time to explain in the courses. But essentially, a chart, if you like, is a form of shorthand for crowd psychology. You couldn't possibly ask hundreds of thousands of people what they're doing and why, and they probably wouldn't want to tell you. But all their activity nets out in the price, and you can read this from the chart. You can infer certain things from the chart. So the chart is a way of monitoring what people have been doing, but most importantly, getting into the mind of the crowd. You're getting a handle on sentiment and psychology. And once you understand people's frame of mind in the market, you're in a better position to predict what the market's going to do, because ultimately, predicting which way the price is going to go is tantamount to predicting how people are going to behave. So what we're really trying to do is get a handle on crowd psychology, and there are certain situations where investor behavior becomes very predictable. The most important one is when people have a losing trade and they hold on to it, hoping the price will go back up, but often it just continues to get worse and they have a bigger loss. So there are certain aspects of crowd psychology which can be predicted. Using that same example, if people were holding a small loss and the price were to rally back up, then that would trigger off selling so that those people could get their money back, and that would push the price down. So this basic concept is very important. We use it in support and the identify where buying and selling may take place. The there's a much longer answer that one could give, but in a nutshell, that is a way in which charts can help predict markets.
What are your favourite techniques?
Well, my favourite technique is point and figure, and many professional technical analysts use point and figure as their primary charting technique. It's a technique that's not very well known or used amongst private investors, but is well used amongst the professional community. Point and figure charts are made up of noughts and crosses. Many people haven't even seen them before, and they differ from conventional charts, line, bar and candlestick, in that they only take account of price movement, not the passage of time. So if there was no movement in the price from one day to the next, there'd be no entry on a point and figure chart, whereas that wouldn't be the case with the other charts. So the net effect of point and figure is it condenses the price action, and also, most importantly, it acts as a filter. It also strips out small reversals in price. So it only actually shows the important moves, and that in fact makes the chart easier to read. Line, bar and candlestick charts include all the noise. Point and figure is the only chart that strips the noise out. So this gives it a number of advantages over the other types of charts, and in fact there are certain patterns which can only be seen on a point and figure chart. So if you're just using the other conventional charts, then you're going to miss a lot of important signals and patterns.